Imagine this. You spent 30 years paying that mortgage. Every single month, you're 64 years old, 1 year from retiring, and you're sitting at the kitchen table looking at a statement that shows $680,000 in your IRA, and you've got $200,000 left on the house, and somebody says, just pay it off. Go into retirement clean. No house payment hanging over your head. Maybe it's your advisor. Maybe it's your spouse. Maybe it's your own gut. So you do it. You pull the money from the IRA, wire it to the bank, and the next morning you wake up debt-free. You own your home completely. It feels incredible. Then the tax bill comes. Nobody told you that pulling $200,000 from your IRA in a single year would push your income into a completely different tax bracket. Nobody told you the IRS would want $40,000, maybe $50,000, maybe more. Nobody told you that Medicare was going to notice that income spike 2 years later and raise your premiums. And nobody told you that you just locked most of your net worth inside 4 walls you can't spend. Stay with me, because today I'm going to show you everything your advisor should have told you before you made that decision. And if you're not subscribed yet, hit that button right now. We do this every week, and this one may be the most important video you watch this year. Here's what you're going to know by the end of this video. You're going to know the 3 variables that determine whether paying off your mortgage is genuinely smart or genuinely expensive. You're going to understand the hidden tax math that most advisors never run before giving this advice, including the Medicare cost that shows up 2 years after the decision. And you're going to have a clear framework, 3 questions, to figure out which camp you're in before it's too late to change course. Everything I share today is backed by IRS rules, Fidelity's own research, and data from Harvard University and T. Rowe Price. No guessing, no fluff. Let's go. Now, before we get into the meat of this, I want to be honest with you about something. This is not a video that says paying off your mortgage is always wrong. It isn't. For some of you, it's the right move. What this video is about is the dangerous way many people do it and the hidden costs that nobody warns them about in advance. The research behind this comes from Harvard University's Joint Center for Housing Studies, T. Rowe Price's retirement analysis team, Fidelity's most current return data, and the IRS's own tax bracket tables for 2025. These aren't opinions. They're numbers. And the numbers may surprise you. And as always, this video is for education only. It is not financial, tax, or legal advice. Please talk to a qualified professional before you make any decisions about your accounts or your mortgage. Let me start by giving this conventional wisdom the respect it deserves. Because it didn't come from nowhere. The idea that you should enter retirement with no mortgage, that was smart advice. For decades, it was genuinely good advice, and here's why. Think back to 1981. Not that long ago for a lot of you watching this. The average 30-year fixed mortgage rate that year hit 18.63%. 18%. If you had a mortgage at that rate, paying it off was the best financial move you could possibly make. It was a guaranteed massive return on every extra dollar you threw at it. Back then, the conventional wisdom made perfect mathematical sense. And for a generation of financial advisors who learned the business during those years, it is hardwired into their thinking. Pay off the house. Go into retirement clean. It's just the right thing to do. But here's what changed, and this is the part most people miss. Millions of Americans refinanced between 2020 and 2022, when rates were between 2.5% and 3.5%. And if you're one of those people, you are in a completely different mathematical situation than your parents were. The advice hasn't updated for you. The world changed and nobody told you. Today, in 2025, the average 30-year mortgage rate is hovering around 7% for new buyers. But for people who locked in during that window, your rate might be 3%, maybe 2.75%. And that changes absolutely everything we're about to talk about. Now, there's one more thing I want you to know before we go further, and it's the piece that no one talks about. The piece that could genuinely cost you tens of thousands of dollars if you don't know it's coming. All right, this is the part of the video I really need you to pay attention to. Most people, when they decide to pay off the mortgage before retiring, do it in one of two ways. Either they've been saving cash over many years and they use that, or, much more commonly, they pull the money out of their IRA or their 401k to do it, and if they're over 59 and a half, they don't pay a penalty. So they think, okay, no problem, I'll just take the withdrawal, pay off the house, and I'm done. Here's what they don't realize. Every single dollar you pull from a traditional IRA or traditional 401k gets counted as ordinary income in that tax year. All of it in one shot. Think of it like a garden hose and a fire hydrant. A small IRA distribution is a garden hose. Normal, manageable. But a $200,000 withdrawal to pay off the mortgage is the fire hydrant, and your tax return wasn't built to handle that kind of pressure. So let me give you a real example with real numbers. Say you and your spouse have $170,000 in retirement income for the year. Social Security, some pension, maybe some IRA distributions. You're in the 22% federal tax bracket. Your tax bill is around $20,000. That's normal. That's manageable. Now say you withdraw $250,000 from your IRA to pay off the mortgage. Your income for that year isn't $170,000 anymore. It's $420,000. And now you're in the 32% federal bracket. In an illustrative example like this, the federal tax bill could jump from around $20,000 to nearly $80,000 for 1 year because of one decision. That's a difference of nearly $60,000 in additional taxes for illustrative purposes. And your actual numbers will depend on your state, your filing status, and your full income picture. But the direction is always the same. Always, the bigger the withdrawal, the bigger the bracket jump, the bigger the tax hit. And it gets worse, because that big income year also affects how much of your Social Security is taxable. Once your combined income crosses $44,000 for a married couple, up to 85% of your Social Security benefits become taxable. Pull $200,000 from an IRA and you may trigger taxation on every dollar of your Social Security for that entire year. But here's the thing that really gets people, and most advisors never mention. There's a second tax hit coming, and it's hiding 2 years down the road. I want to talk about something called IRMAA. Most people have never heard of it, and that's a problem, because it could quietly cost you thousands of dollars per year, and it comes from a decision you already made. IRMAA stands for Income-Related Monthly Adjustment Amount. It's how Medicare decides what you pay for your Part B premium every year. And here's the thing about IRMAA that almost nobody knows. Medicare doesn't look at your income from this year, it looks at your income from 2 years ago. So if you withdraw $200,000 from your IRA this year to pay off the house, Medicare sees that as your income. 2 years from now, when your premium comes up for review, for 2026, the IRMAA surcharges kick in for single filers above $109,000 in income and joint filers above $218,000. For illustrative purposes, a couple pushed into the first IRMAA tier could see their Medicare Part B premiums increase by over $2,000 per year per person. And that increased premium can last for 2 full years because of that single income year. Before recording, please verify the exact 2026 IRMAA thresholds at Medicare.gov, as these update annually. So let's add that up. You paid off a $200,000 mortgage, but in this kind of example, the federal tax bill could increase by around $60,000. Then the Medicare surcharge adds another $4,000 to $8,000 over 2 years. Suddenly you didn't pay off a $200,000 mortgage. You may have paid significantly more just to get a piece of paper that says paid in full. That paid in full certificate has a price. And most people never see it coming because the Medicare bill doesn't arrive until 2 years after the decision. Now, I want to be fair here. Not everyone is in this situation. The tax hit depends entirely on your existing income, your bracket, your state, and your mortgage balance. Which is why the most important thing you can do before making this decision is run the numbers first. With a professional, with a CPA who can model the full picture, not just the mortgage. But there's still another reason why paying off early might hurt you. And this one doesn't involve taxes at all. Here's something I want you to think about. Imagine you have $500,000 in a bank account and $400,000 in home equity. Those are two very different kinds of money, even though they're both part of your net worth. The $500,000 in the account, you can move that to your checking account in 3 business days. You can use it when the market drops and you don't want to sell stocks. You can use it when you have a medical emergency. You can use it to weather a bad year without touching your investment portfolio. The $400,000 in home equity, you cannot touch it, not without selling the house or taking out a loan. That equity cannot pay your grocery bill. It cannot cover an unexpected medical expense. It cannot protect your investment portfolio from being liquidated at exactly the wrong time. And this is where I want to tell you about something called sequence of returns risk. Stay with me. I know that sounds technical, but the concept is incredibly simple, and it may be the most important thing you learn in this video. Think of it like 2 boats launched on the same ocean. Both boats have the same kind of motor. Both are going to the same destination. But one boat hits a storm in the first 6 months out to sea. The other boat gets that same storm 15 years later. Same storm, very different outcomes, because the first boat hasn't had time to build momentum yet. That's what happens to retirement portfolios. Charles Schwab's own research shows that a 15% portfolio drop in year 1 of retirement, combined with continued withdrawals for living expenses, can permanently impair a portfolio's ability to sustain a long retirement, not temporarily, permanently. If you drain your liquid savings to pay off the mortgage, and then the market drops 30% in your first year, you have no cushion. You're forced to sell investments at their lowest point just to pay your bills. Those shares are gone forever. They won't be there to participate in the recovery. But if you kept your cash, kept your investments, and kept the mortgage, you can draw from your liquid reserves during the downturn. Let your portfolio breathe. Wait for the recovery. That's the buffer that protects you. A paid-off house feels like security. But in a financial emergency, home equity can't make a phone call, can't wire money, and can't put food on the table. Liquidity does all of those things. Now, I've told you why paying off the mortgage can hurt you. But there's one thing I haven't told you yet, and it may be the biggest opportunity cost of all. T. Rowe Price actually ran the math on this, and the numbers are worth understanding. Here's the scenario. You have a $300,000 mortgage at 4% interest, 20 years left. You have an extra $500 a month. You've got 2 choices. Option A. Put that $500 a month toward paying down the mortgage faster. You'll pay it off 7 years early. You'll save $25,000 in interest. Great, clean done. Option B. Keep paying the mortgage as scheduled and invest that same $500 a month at a 6% after-tax return at the end of 13 years. At the same point where option A has the house paid off, option B has $119,000 in investments. The mortgage still has $103,000 on it. Yes, but the net worth of option B is $16,000 ahead of option A. and T. Rowe Price was conservative, using a 6% assumed return. Fidelity reports the S&P 500 has averaged 11.5% annually over the past 40 years and 14.8% over the past decade through the end of 2025. Past performance doesn't guarantee future results, and I want to be clear about that. But the gap between a 3% or 4% mortgage rate and the long-term historical return of the stock market is a real and meaningful number. And there's a specific window that makes this even more urgent for some of you watching right now. If you're between the ages of 60 and 63, the IRS has given you something called a super catch-up contribution. Under Secure 2.0, workers in that exact age window can put up to $34,750 into a 401k this year. That's the regular $23,500 limit, plus an $11,250 bonus catch-up, verified by the IRS for 2025. That money goes in pre-tax, it grows tax-deferred, and this window closes the day you turn 64. It is a one-time, time-limited opportunity. If you are 62 and you're funneling your extra cash toward a mortgage at 3.2%, instead of maxing out your 401k super catch-up, you may be trading a government-guaranteed tax shelter for a 3.2% guaranteed return. Those two things are not equal. Every dollar directed to the mortgage instead of this window is forfeiting compounding inside a tax shelter you can never get back. Now, I promise you, I tell you when paying off the mortgage actually is the right move. Because sometimes it absolutely is. And I won't leave you without that answer. Let me be straight with you. There are real situations where paying off the mortgage before retirement is the right call. Genuinely. And I'd be doing you a disservice if I didn't lay them out clearly. First, your mortgage rate matters enormously. If you bought or refinanced recently and your rate is 6.5%, 7% or higher, the math shifts. Eliminating a guaranteed 7% interest cost starts to look more attractive when compared to uncertain market returns. Charles Schwab puts it simply, it's wise to pay off your mortgage when your interest rate is higher than the long-term average return you expect on your savings. For high-rate borrowers, that calculation may favor payoff. Second, if you've already maxed out every tax-advantaged account available to you, including your 401k super catch-up, and you have excess savings sitting in a taxable account with no better use, then directing some of it toward the mortgage becomes a reasonable move. Third, I want to say something about the emotional side of this, because it's real. Some of you watching this cannot sleep knowing you carry a debt. Some people will genuinely spend more freely, feel safer, and live better in retirement if they know the house is theirs outright, that psychological value is not zero. If carrying a mortgage into retirement creates genuine anxiety that diminishes your quality of life, that's a legitimate factor. Just make sure you're pricing it correctly against the tax and liquidity costs we talked about. And fourth, if your retirement income is tight and that monthly mortgage payment represents a real burden on a fixed income, eliminating it may be the right call for simple cash flow reasons. So here's the honest truth. The goal of being mortgage-free in retirement is not the problem. The problem is doing it the wrong way at the wrong time without running the numbers first. And now, let me give you the 3 questions that will help you figure out which side of this line you're on. Here are the 3 questions. Write these down if you can. Question 1. What is my mortgage rate? If your rate is below 4.5%, the math on keeping the mortgage and investing instead tends to favor investing, particularly for retirees with long horizons of 20 years or more. If your rate is above 6.5%, the math starts shifting toward payoff, between 4.5% and 6.5%. It depends on your tax situation, your risk tolerance, and your income. Question 2. Have I maximized all my tax-advantaged retirement accounts, including the super catch-up, if I'm between 60 and 63? If the answer is no, there is almost always a stronger financial case for doing that first. Pre-tax contributions reduce your income. Now, grow tax deferred and represent $1 government subsidy that a mortgage payoff cannot match. Question 3. What does the full tax picture look like if I make this IRA withdrawal? Sit down with a CPA, give them your current income, tell them the amount you're considering withdrawing, ask them to show you your federal tax bracket before and after that withdrawal, your IRMAA exposure for the following 2 years, and how it affects the taxability of your Social Security. That modeling session may be worth thousands of dollars, and it should happen before you wire any money to a bank. Those 3 questions don't require a finance degree, they require a conversation. And it could be the difference between paying $20,000 in taxes and paying $80,000 in taxes on the exact same decision. Now here's the thing that almost nobody tells you, and this is the part of the video I really want you to share. Most people believe that keeping a mortgage means they get a tax deduction. I don't want to lose my mortgage interest deduction. I hear that all the time, and for most of you, that concern is based on a myth. Here's why. After the 2017 Tax Cuts and Jobs Act, the standard deduction nearly doubled. Today, a married couple where both spouses are 67 gets a standard deduction of around $33,200 before they've written down a single expense. For most retirees with modest mortgages, the mortgage interest they're paying doesn't even move the needle past that standard deduction. They're getting zero tax benefit from the mortgage interest deduction already. About 90% of taxpayers now take the standard deduction. That's according to the Tax Policy Center. Which means for the vast majority of retirees watching this, the "I'll lose my tax deduction" argument is simply not a reason to keep or pay off the mortgage. It's already off the table. This worry for most people is not real. The IRS already changed the rules, and most people haven't updated their mental model, so the mortgage isn't giving you a tax break, and paying it off isn't taking one away. What it is doing, potentially, is triggering a massive new tax if you fund the payoff with an IRA withdrawal. That's the twist. The thing everyone worries about losing, they don't have, and the thing nobody worries about paying, they absolutely do. Here's the one thing I want you to remember from this video. Paying off your mortgage before retirement isn't automatically smart or stupid, but draining your IRA to do it, without first running the full tax math, could be one of the most expensive decisions of your financial life. Read that again if you need to, because I mean every word of it. All right. Here's what I want you to do this week. Concrete steps, small and doable. First, if you're between 60 and 63, call your HR department or your plan administrator today and ask whether you've maximized your 2025 Super Catch-Up contribution. The window closes at 64. That's not a conversation to put off. Second, before you make any IRA or 401k withdrawal for any purpose, model the tax consequences first. Tell your CPA exactly how much you're considering withdrawing and ask them to show you the tax bracket impact and the IRAA exposure for the following 2 years. That conversation should cost a few $100s. The alternative could cost tens of thousands. Third, run the liquidity test. Before you pay off the mortgage, ask yourself, if my portfolio dropped 30% 6 months from now, would I have enough in liquid, accessible savings to cover 12 to 24 months of living expenses without being forced to sell investments at a loss? If the answer is no, pay off the mortgage only after you've built that cushion. Fourth, compare your mortgage rate to what's available on safe, low-risk alternatives. If you have a 3% mortgage and current Treasury notes are yielding 4% or more, you can potentially earn more on a government-backed instrument than you're paying in mortgage interest. That's worth knowing. And fifth, if you do want to eliminate the mortgage, consider doing it gradually. Small extra principal payments over several years, staying inside your tax bracket, never triggering a spike. You can often pay off a $150,000 mortgage in 8 to 10 years without a single dollar of IRA withdrawal and without a single dollar of extra tax. Before we wrap up, if this video helped you see something you hadn't seen before, I'm going to ask you to do one thing. Hit that subscribe button. We put out videos like this every week, built on verified research, written in plain English, for people who are actually close to or in retirement. No hype, no products to sell, just information you can use. Here's what I want you to take away from today. The dream of owning your home free and clear in retirement. That's a good dream. There is nothing wrong with that goal. It's the how and the when that matters. The people who get hurt aren't the ones who want to be mortgage free. They're the ones who pull $200,000 from their IRA without running the numbers first. They're the ones who didn't know about the tax bracket. They're the ones who didn't know about IRMAA. They're the ones who didn't know the standard deduction already made the mortgage interest irrelevant. You know all of that now, and that knowledge is worth real money. If this video helped you, would you do me a favor and share it with someone who's thinking about this decision right now? A brother, a sister, a neighbor who just got a retirement date and is thinking about cleaning up the house debt. They may be about to walk into something they can't walk back out of. And you can help them. Drop a comment below and tell me, do you have a mortgage going into retirement? Tell me your rate and how many years are left. I read every comment and I'd love to see what you're working with. I'll see you in the next one. For educational purposes only, not financial, tax, or legal advice. Please consult a qualified professional before making any decisions about your retirement accounts or mortgage.